users of this who really need it are going to be those places that have downtowns they have not successfully converted into hot areas, and this I think will be the earliest kind of fruit of where you see dramatic change in solving a big problem that a lot of places are sharing.
I think that's probably a little bit different for Reno. I think they've done the community up here has done a great job since the recession of the headlines back in the recession were Reno, Detroit to the west, and the gaming industry wasn't going to come back. And I think that the community up here has done a great job at diversifying the economy, bringing in advanced manufacturing, really building a culture of entrepreneurialism. And I think that ties in probably, hopefully, for the next section of regs when we're talking about business opportunities. I think one of the unique parts for us in Nevada is we did designate both of the Carnegie Research Institutes, UNLV and UNR, their campuses are in opportunity zones in the surrounding areas, and just being able to develop some of the tech space there. Do you foresee this program being involved in some of those incubator startups and being able to provide capital that otherwise isn't accessible to those folks?
Yeah, I mean, it was frankly the whole goal of the program. I mean, this is a very broad, flexible program, but it was built around a vision of reducing the pull on entrepreneurs to have to go to a handful of places to be close to capital markets by bringing the capital markets to them. And frankly, I'm sure you guys have heard the stats, and I've known and worked with Steve Case at Revolution Capital in DC for a long time. And it's not his stat either. It's actually self-reported from the venture capital industry that now it's close to 80% of venture capital is invested in 3 states. I don't know if anyone saw the 60 Minutes on Sunday where they profiled what he was doing around that, but that's in Massachusetts, California, and New York. That's an outstanding number. Astounding, not outstanding. An astounding number. And as you break down the demographics, it even gets more unfortunate. I mean, 10% of venture capital goes to female entrepreneurs. 1% goes to black entrepreneurs. Lots and lots and lots of research show that female entrepreneurs are much better entrepreneurs overall than male entrepreneurs are. But even if you didn't believe that, those sort of numbers are just not sustainable for our country. And it's because that there's a herd mentality, there's a club mentality when it comes to investment. And one way I think you break it is by creating that geographic pull. Roughly 60% of people who live in opportunity zones are not white. And so this is not just this is on its face a geographic program, but this is also a program getting capital to and opportunities to folks based on socioeconomic status, based on demographics, based on really allowing people to stay where they want to raise their families and where they want to grow up, and sort of believes in the notion that there are great entrepreneurs in every city. I believe that. I think there's lots of data that supports that's true, but practically speaking, even now, if you want to get your first round of capital in most cities around the country, after that you have to leave, which means you take that growth business with you. And so there was a little bit of a hiccup in the regulations around around whether you can invest in growth businesses, because Treasury created a provision that said businesses that are investable have to get 50% of their revenue from the zone they're in. That was a huge mistake. I think Treasury has since admitted publicly they interpreted that incorrectly, and I think you'll see that changed in this round of regs, where Treasury will be fine with businesses selling anywhere around the world, whether you're a manufacturer or a tech company and you want to sell around the U.S. or around the world. And they're really focused on making sure there's a real business in the zone and that its physical assets are in the zone or in zones. So that will be at one turning point to enable more of that. But yeah, this program was designed to do what community investment programs hadn't done well. They've done real estate, commercial real estate before, whether it's new markets or light tech or historic tax credits or other programs. But really, none of those programs had been successfully able to get venture capital spread out in a bigger part of the country.
As we talk about that balance and being able to make investments in those zones and making sure that the capital is deployed there and you're actually helping the people in those zones, do you have any advice for an investor that's looking, or an opportunity fund that's being developed that's going to make investments into those zones, and some of the practices to make sure it's successful and not just displacing folks?
Yeah, well, listen, I think one element of this is where you invest. So I work with very few funds that invest sort of outside of the heartland. That my funds, for instance, I don't think investing in New York is a great bet in this program, because that's a market that's very expensive, where there's tons of competition, and I have no idea what it will look like in 12 years. Maybe it's grown some, maybe it hasn't, but I certainly buy the growth of Reno over 12 years, and I buy the growth of Detroit over 12 years, and I buy the growth of Nashville and St. Louis over 12 years. So when I think about good investments from a geographic perspective, that's where I start. Urban Institute did a study of opportunity zones to be able to evaluate how much potential displacement might occur there, and they found that 96% of zones have not been gentrifying. 96% have not been. 4% have. Those 4% get a lot of headlines. I'm concerned about those 4%, but unless you're in Houston, those 4% have local leadership that have all sorts of ways to gatekeep for the type of investment they want and don't want. Obviously, we saw this in Amazon and Long Island City, where they refused a huge investment that the rest of the country competed over for similar reasons. And California and New York, I think, both make it pretty difficult to build. And that's how they are dealing with, or I think attempting to deal with issues around gentrification. Most of the country, this is not a real issue. Now,
And Nevada was 0.
say it again?
We had 0 tracks that were part of that.
Yes.
Yeah.
So again, it doubles in the details. I'm sure there are tracks here where people, where that may come to mind for folks, or maybe not. But as I think about sort of moving past that, because that's not really the only thing you ought to be thinking about. Funds have to get past the stage of just thinking about fund formation and capital raising. Have to get to the stage where they're figuring out how they're going to engage with community partners. And if you particularly on the real estate side, this is a different type of development than most developers do in this country. Most developers are thinking in a 3 or 4 or 5 year lens. And if you're thinking in this program, practically speaking, in a 10 or 11 or 12 year lens, I think your approach to development is different. I think you care about making sure you've got sustainable people who can, or a sustainable economy that supports people that can rent your buildings, whether it's businesses or whether it's residents, that people want to live there, that other people are investing around there, that you've got the retail to make that, and the amenities to make that attractive. It creates a positive ecosystem, and of course you need the businesses there too. So, I think creating a partner and a strategy, not just with the cities, frankly, but I encourage my funds all the time to work with other funds and to co-invest together and to, where it aligns, talk about their strategies together, because there's not a lot of competition, at least among my funds, because I work with a small group of them, around individual deals, and I think there's a lot more to gain from working together. I think now everyone's a little bit competitive because they're feeling the pressure of having to raise capital and having to find deals, but over time, I think you're going to see funds working together and aligning strategies so that they're supporting each other by both investing in the long term in places and by that protecting each other's investment, which of course is good for the communities.
So I want to make sure, we're asking the questions that we have, but this is for you guys. So we can ask, if you have questions, we can do Q&A anytime throughout this, or we just keep going. So raise your hand. We have microphones we can pass around. Do we have the mic runners? We'll get that going, and they'll, but we'll keep going until they bring you the mic. So I can just say talk, and you can just.
Well, I mean, someone's got to be the first question, though, right?
Yeah, if someone has a question, we're just waiting for the mic.
Oh, okay.
Yeah. Yeah. We want the people in the back to hear you.
The biggest difference is usually my fee. I was making a joke.
I'll make a note.
So, obviously the rules of this program are new and require different behavior, or at least specific behavior, in the deals. So a couple of really kind of baseline examples. We talked about the length of time. I think right now in this program you have to assume you've got to stay invested in an asset for at least 10 years. So that's one piece you've got to organize around, which means that affects other parts of your investment decision. It's going to affect, for instance, I think how Treasury and IRS look at refinancing deals. I think it's going to affect how they treat depreciation and accelerated depreciation in deals, which are common tools that are, I think, going to work a little differently in this program. Two, you've got to substantially improve the assets. That means you can't just acquire an asset and sit on it. You've got to invest roughly at least as much into the asset as you acquired it for, minus the cost of the land based on the regs. And so you've got to deploy that money over a certain period of time. You've got to deploy that within 30 months. So the timing of how you invest matters. How you join venture in this program is a little bit complicated if you're using opportunity zone fund and non-opportunity zone capital, what the relationship is like between the fund, the money, and the developer, which may have slightly different incentives. The developer, if they're not using opportunity zone capital in like a third-party deal, may want to get out of the deal earlier, and the fund has to stay in there for a long period of time. So a lot of it is just applying what happens predominantly in real estate to this program. Now, I work with two private equity business investment funds that are really just getting started, and that industry is brand new. As we get the clarity on how you, for instance, substantially improve a business, that will create, I think, a whole other circle of activity around how you do business investments in these zones. And well, there's plenty of other issues to talk about, how funds exit out of deals. That is a little bit complicated right now too. But really it's how you apply. You're doing development, the same kind of core tool. You're using the core tools of development, but you're applying them in a different way over a longer period of time with constraints over when you invest and how much you've got to put into it. That's for sure.
Can you talk a little bit about the exit and what you think is going to happen with the regs? And because I know that's something that gives a lot of people heartburn.
So let me provide a little bit of context to that question. So there's essentially two types of funds in the market: single asset funds and multi-asset funds. And in single asset funds, the exit is not very complicated. You get to the end of 10 years, you essentially sell your fund, your entire fund, which is usually an LLC holding the piece of real estate, let's say, to an investor, and that looks like a typical real estate deal. If you're a multi-asset fund, let's say you've got 10 assets, and let's assume you've held them all for 10 years or more. So you don't owe Treasury anymore. You've met your obligation to get that full step up in basis, that full capital gains tax forgiveness when you sell. Right now, you only have one purely safe option, which is to sell the whole portfolio of assets, whether you do that through a REIT or you do that just through a portfolio. And that's really hard because, and I'll explain though, I think it gets better, but that's sort of the default because of a kind of a quirky part of the regs, which I'll talk about. And that's hard because you're not going to get the full value for those assets. It's going to be harder to find a buyer. And from a policy perspective, you're going to depress communities that you've just spent 12 years building up and growing. So lose all the way around. Now, the reason you have to do that right now is because you get the benefit as that full step up on your capital gains tax for selling your interest in the fund. And because most of these funds are structured as LLCs, if you sell an individual asset, you've now created a taxable event for your investors, even if you've hit 10 years. And so what I think Treasury is going to do to deal with that, and they've hinted at that, is that they're going to allow funds some kind of dissolution period once they've held all their assets for 10 years and say over this period of time, let's call it a year, you can sell the individual assets out of the fund, basically fill the fund with cash, and then redeem your investors and they won't have a tax penalty. So it's a technicality. I don't think there's a policy reason Treasury wouldn't do that, but you can't safely do it right now in the regs. And so if you're one of these many diversified funds, you have to tell investors, well, if we don't hear anything better, we'll have to sell the whole portfolio at one time. But we think, and I think everyone in the market, for more or less thinks, that they're going to allow this provision to exit out of individual assets, which matters a lot because most of the capital in this program will come from those diversified portfolio style funds.
Most of, we'll go to a question next. Most of what we talk about is real estate and opportunity zones. Can you talk a little bit about businesses and opportunity zones?
Yeah. So you can invest in businesses through opportunity zones, and we've touched upon this a little bit throughout this conversation. But let me distinguish three types of businesses real quick, just for people to have a sense of that part of the market. One, you have brand new businesses. So businesses that are created, let's say, in their mandate to be opportunity zone businesses. They have, essentially no property. They've just started. They have no capital yet. That you can do right now. I would say most lawyers and accountants would say there aren't a lot of obstacles to starting a brand new business. And in fact, most real estate is going to be embedded in the creation of a new acquisition and development business through this program on the real estate side. So there's two other categories of businesses. Businesses already in the zones and businesses moving into the zones. And that's where things start to get a little murky. There is for sure a substantial improvement test on businesses like there are in real estate, and it's based on their property. And the test for being a business, really the core test, is 70% of your tangible property, your physical stuff, the buildings you own or rent, your desks, your computers, which in most cases will also be where your employees are. 70% of that property have to be in opportunity zone. That's the test. It's been laid out in the regulations. I think it's very unlikely to change. But you've got to not just invest in those companies as the investor, but that investment has to lead to the businesses improving or growing that company. And how businesses have to meet that test so that the investor is investing in a qualified business is very much up in the air. But I do think it's a question Treasury will resolve in this round of regs and provide a process for investors and for the companies that are being invested in to stay qualified so this continues to be a viable asset class. But because we don't know how to substantially improve businesses right now, the business investment market has basically been on hold. Besides, I've seen funds and talked to funds in the venture capital space that are basically making seed investments in new companies. That's doable. There's other reasons business investment is always going to be more complicated, though. Businesses are mobile. They can leave the zone. They can grow out of the zone. That's unlikely to happen in real estate. You can pretty much control your exits when you own real estate. When you own business, it can be acquired. You may own a minority stake of that business, and they may sell to another group of investors. You have no control, and now you've had an exit in that fund before 10 years. So I think these are going to be real issues that business investments will have to reckon with, unless Treasury allows funds to move in and out of assets within that 10-year period of time that they've locked up the investor's capital. And frankly, that was the design of the program. Congress has said to Treasury lots of times, that's what we want you to do. We want you to allow funds not just to have to hold assets for 10 years, but to hold for 5 years and to reinvest in another asset with those 5 years and meet the program. But Treasury has not been supportive of that approach, and I think they're unlikely to get there soon, and I think that will continue to be an issue, particularly for business investments. I actually like the impact on real estate because I like the longer-term nature of these development projects, but it does create a strain on business investors who are going to need some kind of safety valve if their business moves out of the zones or gets acquired early so that those funds will be viable.
Questions?
So with regard to your last analyses, this is where I get an enormous amount of heartburn in terms of the ability of our opportunity zones to do its best and opportunity funds to do its best work. Because once again, we have half of an apple, or maybe we have a third of an apple. We draw equity easily, arguably easily, into real estate investments, and it then is incredibly difficult to do the other half of that apple, and that is to draw equity into business growth and business development. That's scary. Because in all of your comments, you've talked about the importance of an integrated approach and a long-term approach, but we don't have the opportunity to easily get investing in businesses. That, I think, is a real challenge.
So I worry about that too. Because I have a sense of where the regulations are coming with Treasury, and I know that they're facing a lot of pressure, including by Congress, but also frankly from others in the administration to make sure that this is useful for business investments, in particular growth businesses that can create a lot of jobs. I do think they're going to create a set of rules that make that more viable. They're going to fix that test that enable businesses to sell to more places. They're going to create a substantial improvement test that I hope is workable for businesses. Again, going back to sort of the very beginning of the conversation, we're in inning one. I'm expecting there to be some stumbles. I'm expecting us to have to work through the regs. Treasury and IRS don't always have a great sense of what's actually happening in the marketplace. And that means the marketplace has to make them aware of what needs to happen around this. And as there's more interest in business among business investors, they feel they have more skin in the game, I think they're going to have a louder voice in the space to get the regs to the place we need to be. But I'm still optimistic we're going to get there. We're at a place now that's not workable, but that's mostly because you can't responsibly, I think, invest in existing businesses in this program because you're basically guessing. Now, let me make so I hope that answered the question. I want to make a related point to that. This is a program that rewards a lot of pioneering and entrepreneurship as investors and fund managers. And the reason I say that, this program puts all the pressure on the investors. They're the ones who get the incentive if they succeed, but that's only if they succeed. If your investment fails, and lots of business investments, for example, are going to fail, that's it. There's no government's not coming in to rescue you. And so the fact that there's so much risk with investors and the fact that you don't have this upfront guaranteed money coming from the government, what that means is that the government has set very low penalties in the program. And really the penalty for a fund missing the mark is the underpayment tax penalty rate. Like if you pay your taxes late, which is now at 5 or 6%. It's fairly low. But the Treasury has really broad, and I think we'll speak out about this soon, abuse prevention powers. And so I think there was something mentioned about this on stage earlier. I think Tim may have mentioned this. When you're thinking about an opportunity zone fund, particularly now, well, one, don't screw it up for everyone by doing something that's right at the borders. And I get questions around this all the time of funds that want to do stuff that's really not even in a gray area, like in a red area, but it doesn't explicitly say you can't do it. Don't be one of those people. But I would expect Treasury and IRS to bang on all those, on any fund that is not reasonably complying with the intent of this program. And I would expect, and this is true of all early programs, that Treasury and IRS will over-audit funds to get a sense of what's happening in the marketplace so they can readjust. So when I talk to my funds, I'm very optimistic and forward-leaning in terms of what funds can do, but I'm very conservative in how I interpret the rules in the statute. And for instance, like on the business investment front, until they say more, I tell funds they can't do it yet, because you don't want to be in a place where you're operating kind of not with this reasonable intent you need to be, because I do think there'll be meaningful penalties that IRS and Treasury will put in. Now, you can do a lot within that, though. If you're kind of guessing on something 50-50 wrong, I wouldn't worry about a penalty. I wouldn't worry about any kind of big repercussion. There are no criminal penalties in this program. There are no civil penalties. You're really just paying a late payment fee from the IRS. And so it allows for a lot of experimentation, particularly when we have these rules in the business, in the business investment side going forward. And I think you're going to see a lot of creative stuff. And I already see a lot of creative stuff. People are using opportunity zones to fund education infrastructure. There's a major foundation using it to fund charter schools around the country, even separate from that. I work right now on renewable energy projects all around the country, in solar and wind, using PACE financing in real estate. I see this in the kind of film and media production space. There are lots of creative uses of this program. Anything you can put equity into, you can invest in through this program with a couple exceptions. You really can't invest in financial institutions. No investing in banks, no investing in payday lenders, no investing in things that have non-qualified financial property, but basically financial institutions. I've been cut off. Oh, okay, I'm back. This must be run by Citibank or something. Two, I make this joke a lot. I'm not sure if it's funny with every audience, but I find it really funny, so I'm going to tell it anyhow. You can't invest in massage parlors and country clubs and golf courses and sin businesses. So I say anything Donald Trump would invest in, you can't invest in. So that's one lens to view the program. Mixed laughter from the crowd. I see we're in a red state. So that's the other prohibited categories of investments. And basically you can invest in everything else other than that. So you can be very creative, and these rules, I think, will enable that.
Questions?
Yes, I'm wondering if the three of you could work with the EDON, Brian McArdle at EDON, to essentially create a prospectus factory. Kind of a clearinghouse where you could help us to create all these prospectuses. My name is Gordon Gossage. I'm with a company called Regenesis Reno, and we're doing a 10,000 unit project where we're determining where the most beneficial 10,000 units of housing could be built in the Reno area. And so we're doing a lot of work to identify projects, but to really have them be of the quality, have the prospectuses of the quality that I think they need to have. Could the three of you work with Brian and create a clearinghouse?
Have you already talked to Corey about this? Because Applied Analysis is already working on this, I believe. Corey, are you in the room?
And I'll piggyback on
Yeah.
that. So EDON is the Governor's Office Regional Development Authority. So we work with them very closely to make sure that we're working together on projects. But what Keo was alluding to is there's a growing effort out there to make sure that we're putting together more local maps, not just a statewide effort, to make sure that the local efforts are being able to put their projects or foreseeable projects in a graphical view and have a mechanism to update those for potential investors to come in.
Actually, I specifically mean the prospectus themselves, just really to vet our prospectuses for investment, make sure that they are targeted. That would be great if you guys can help on that.
Question? We'll talk later, Gordon.
So I'm an attorney who works a lot with brownfields developers, and what I'm trying to get to is how you deal with raw land under this. It seems like the time frames for investing are so short that you don't really have the ability to do either the environmental assessment and remediation that you would need to do, or just for any other raw property project, the zoning and and community discussions that you would need to have. So how do you deal with all this preliminary work for those types of raw property approaches?
So I think there's a big picture and then a kind of a more practical answer to that question. The big picture answer is you can deploy new investment, and I work with a lot of ground-up developers and developments, and it is trickier, I think, than rehab. There's no real time constraints around how fast you have to invest in those projects as projects, and you can deploy new investment between now and the end of 2026, so you've got a pretty long window. The challenge is timing investor capital, which is capital gains capital, and for many investors won't be that accessible or liquid when you may need it in the project itself. And I think that's very hard to do, one, unless you've been able to find another way to finance pre-development, which I think there's no way really around that. You really need to get to more shovel-ready deals. Two, the larger funds I work with and who are doing multiple projects are really lining them up simultaneously. So they've got projects that can take in capital, let's say every 3 months or every 6 months, from their investors and make it predictable for them, and they're investing in the portfolio anyhow. And then I think, for large projects, it's going to be important to phase out those projects. So you're really getting investment in, like, let's say, life cycle 1 of the fund in phase 1 of that project, and then in phase 2 and 3